Good morning, everyone. Welcome to our Tuesday morning trading session. Hold on here 1 second while I get you my monitor. Okay, you should be able to see my monitor. The market's just opened up. Let's take a look here at the Falcon. Actually, this is true for any of the markets, but it's very clear on the Falcon and the Eagle. There was no overnight trading, at least not in the NASDAQ last night. The market left off around here, nothing or next to nothing during the Asian session or the European session. And here we are this morning. No doubt everything or a lot of activity is hinging on what's going on with Greece. If you've been following the news at all, I haven't been following it that closely. I just know the rough details. But I do know that the market is going to be very sensitive to that. And you can see we've been following a pretty nice little channel here, which I'm just highlighting, just so we have a rough idea how the market is behaving. Oh, good morning, Marlene. I'm glad that you can make it. While we are waiting for something to develop, I'm just taking a look here also at our soybeans and crude oil markets. And of course, I can take a look at any market which is of interest to you, but at the moment, it looks like the fur is flying a little bit. I think we'll give them a few minutes to sort themselves out. All right, this is probably a good opportunity. It's something I've wanted to talk to you guys about for a little while. I've never really addressed this issue. Here we could probably do it on the Raptor. It's as good a tool as any. Okay. You know how we look for things like tests of the extreme and tests and retests and so on and so forth. Sometimes Marlene sent me an email the other day, and she was asking why some signals work out better than others. Like, as you know, not every first micro-macro cross signal works. Technically, this is a first micro-macro cross right here. And in this case, we're still sweating the trade, depending, of course, where you placed your stop. So this is why I suggest to you that when you place your stop, you don't always default to the stop strategy. You want to take the chart into account, and sometimes that will mean placing your initial stop, a little bit further away. And by the way, if you have a market like this, and we're going to start with the hawk, if the markets remain quiet this morning, we'll work through all the charts this way. But let's start with the hawk. If you have a chart that has a bunch of yellow bars, and the yellow bars are printing more or less along the same latitude, it's one thing if yellow bars are printing like they are down here. You see they're kind of lower, then they're starting to print a little bit higher, and then we get our first micro macro cross. Okay, this is the type of signal that you can have a little bit more confidence in, because the yellow bars don't mean so much. It's a natural progression. We're making higher highs, higher lows. Okay, we get a first micro macro cross, away we go. Compare that with what we're looking at here this morning. the market has definitely begun to flatten out. Right? That should be fairly simple to you if you just take a basic visual of it. If it's hard for you to see, you know how we're always drawing trend lines across the bottom? We'll do the opposite. Draw trend lines across the peaks. And you will begin to see that this market is starting to flatten out. So here now is our first micro-macro cross signal. We know it's a high probability signal. Should we take this signal? Yes, we can definitely take this signal, but given the circumstances, we'll probably want to dial down our risk amount or maybe just put a onesie on it, see what happens. Now our stop strategies are right here, but you can see placing our stops within this whole range, well, we're kind of asking for it, aren't we? We know the market is really confined between, well, ideally below these lows here and these highs up here. But we can also use these intermediate lows perhaps to cover our trade. So in this type of instance, I'm going to turn my stop strategies off for the moment and give this trade a chance. So the market brings us in, it begins to flounder, we're taking some heat. Okay, now at this point here, where the market has begun to progress higher, this is time for us to now start rolling our stops. All right, so even though the quality of the signal is coming into question now, we have an opportunity to manage our trade a little better. So as the market progresses, you know, we can keep rolling our stops depending how aggressive you want to be on this. And the market reverses and takes us out for a loss, but we're probably looking at, I don't know, maybe, well, not even a $50 loss. So probably a $30, $40 loss compared to the initial risk. All right, so that's one thing that you can do to protect yourself. But the point that I was going to get at was that the market goes through different phases. And sometimes it's important to recognize which phase of the market you're in. Now, the typical market phases are as such. The market will spend a period going sideways, then it will rally, then it will spend a period going sideways, and then it will decline. Now, these periods actually have different names to it. This first phase down here is called the accumulation phase, and this phase up here is called the distribution phase. Whatever you call them, the principle remains the same, and it occurs time and again. So sometimes part of the battle is knowing which phase of the trade you're in. So for instance, if you suspect that you're in this distribution phase, that the market has been flat, it's put in a good rally, now you're in this phase here, well, what do you anticipate after that phase? Well, you anticipate the market to head lower, right? Now, these moves are not always equal. If they were, the market would eventually be flatline. Sometimes these moves end up looking something like this, where you get this phase, you get this phase, you get this phase, then you get this phase, and then you get this phase, and the market goes up again. All right, so these phases are not always equal in nature. But having an idea where you are in this, you know, whether you're in the accumulation phase or whether you're in this distribution phase, sometimes will help you gauge the quality of the signal also. So right now, where would we say that perhaps the hawk is? Okay, the hawk is a little bit um, busy. This might be easier to see on a tool like the eagle, but to me, we've obviously had a run up, and now we're obviously going sideways. Now, does that mean that we don't take quality signals? Here's a first micro macro cross to start the day. Does that mean we do not take that signal? No, but if I suspect we're in a distribution phase, which would precede a move lower, I need to be a little extra cautious, don't I? So I'll take the signal, but I'm going to perhaps run a deeper stop. I'm definitely going to go in with a onesie. I might not think about, or I'll definitely think about going all in, all out on target. Sometimes when I go in with a onesie, what I'll do is I'll delete the profit objective, see if I can get a little bit more, and perhaps consider adding to the position if the market continues in that direction. So here the signal went up, found our profit target, and now we're floundering again. So now we're going to come back with a red bar buy signal, which is not our highest quality signal, but we haven't really had a test of the extreme of these highs, right? So now we need to think, well, are we going to get a test of the extreme and then a failure? Should I try to take advantage of this trade here, or should I wait for the market to possibly reverse and give me the failure? Okay, now fortunately the red bar buy went away. We're into yellow bars, so I don't need to worry about it, but these are the kinds of questions you have to ask yourself. And it's okay to miss a trade. Now, I say that, but yesterday, I was a little bit slow on the draw, and I missed the better part of this move here, which is annoying, but you can see that the market open, gave us a first micro macro cross, bolted. We had another chance. We had a macro pullback, went higher, had a red bar buy. We had opportunities here. So you don't need to, another first micro macro cross over here. So you don't always need to, it's nice to be on that first move, but you don't always need to panic. If you miss the move, you miss the move. I've been doing this for a long time. Believe me, you're going to miss moves. I miss moves all the time. All right, let's take a look at this concept here with the Falcon now. And you're going to see as we go into our bigger tools, these things are going to become a little bit more evident. So there's the Falcon, and these moves can be, there's no time frame allowed for them, and they're not always textbook. The NQ's been rallying for a while. I should maybe take a look at crude oil or something. In fact, why don't we just go straight to the Eagle? Okay, so here's the Eagle. Huge move up. What preceded that move up? Well, we had kind of a mini. Here's not a bad example. Here's the whole concept in miniature. Normally it's spread out a little bit more than this, but you can see here's the sideways, here's the up, here's the sideways, here's the down. Now, normally there's a little bit more sideways action here before the next up, but the principle remains the same. And it isn't, like I said, it isn't always textbook. Sometimes it's difficult to look at this and say, okay, the market's been coming down. I guess the tip off is when it starts to go sideways. If you start to connect the dots, well, I call it connect the dots, but in a downtrend, if you start focusing on the lows and you recognize that they're starting to get shallow, that things are starting to move a little bit more in a sideways fashion, then perhaps you can say, oh, maybe we're in this phase here, and from here the market is likely to move higher, and then it's going to plateau, and then it's going to go either like this or it's going to go like this and like so. All right, so I wish I had something that was a little bit more textbook so you could see it happen, but let's take a look here, perhaps crude oil. So sometimes just knowing which phase of the market you're in is helpful. So how does this look to you? Well, I would say the market has come down. We've kind of flattened out here. We've had a little bit of a rally. Now we're going flat again. Okay, so out of this flatness is going to come the next move. Right? At this stage, it looks like, well, maybe that was already our little dip and we're going to get another rally. But just knowing that we're in this stage right here gives us a clue that we don't have to, take any types of trades inside here. In fact, what you could do is you could just wait for the market to get outside of this range entirely. I know it's a big range. I know there's lots of opportunities in here, especially for your hawk and your falcon. But look at what happens when the market gets outside of these ranges. Right? The market gets outside of this congestion, prints a signal, it goes a little bit higher. Market, this one not so much congestion, this is more of a textbook type signal, but here the market is in congestion. Right? It gets outside of that congestion and then it goes higher. In congestion, keeps bouncing back and forth, gets out, moves a little bit lower. So if you're looking, to identify high probability signals, sometimes it's just a matter of letting the market sort itself out. And of course, these things are much easier to do in hindsight than real time, but you can see the principle remains the same. Actually, this one's not so hard to do real time. It's pretty easy to identify when a market is in congestion. The difficult part is avoiding that sell. Now, when that's printing, that's actually a pretty reasonable rule of three. It's actually just two signals, but this one would not be so difficult to spot. This one would not be so difficult to take advantage of because we've had the test of the extreme, the failure, we're printing a sell signal. But you can see in each one of these instances, there was really no rush to get into a trade. Yes, here's a red bar buy. Yes, it's a high probability signal. Yes, it's bouncing off the trend line. There's a lot of reasons to take that trade. But look at when the market is moving. It's moving when it gets outside of this range. In fact, you could have even made this range a little bit, perhaps tightened it somewhat. So I know I've covered a few things here, but if you take a look at the market from that type of perspective, yes, you're going to have fewer trades, but your trades should also have better follow through to them. if that makes sense. Oops, I see Marlene's question came a little. I didn't notice your question until right now, Marlene. Marlene asked, what about the buy before that one? Okay, you're going to have to refresh my memory which chart we were looking at. And like I said, it's okay to miss a move. It's annoying, it's annoying to get this red bar buy, have the market run on you, and you're sitting back here saying, why didn't I buy that? But it happens. Okay, so Marlene's saying the NQ Eagle. So you guys have noticed what I like to do on my Eagle is I like throwing in these trend lines. And I'll very often channel the trend line. Okay, so with the Eagle, we know our hard edge bounces, our red bar buys and uptrends, and green bar sells and downtrends tend to be very reliable signals. So we had a signal right here. We had another red bar buy signal down here, just around the London Open. So those are our quality signals. If you took a look at the market, I don't know, if you took a look at it this way and you said, well, we're making higher swing lows, we're making higher swing highs, so everything is looking a little bit bullish, but let's kind of play this out if it were happening real time. Okay, if this were happening real time, I might have said, okay, we've had a breakout like this. Now to the downside, I might be expecting the market to get a little bit more bearish, but then what it does, it comes right, oops, sorry. They need to give me bigger arrows here. So now the market is getting a little bit bearish, and now it's drifting back inside our range. So in which case I would now adjust the range like this. Now if you're just looking to get outside of this range before you commit to a signal, you've got a little bit of waiting to do. Now we're at the top end of the range. Okay, now we're out. So now we're looking at this whole test retest thing, right? We're looking for the market to get out. We're looking for it to come back, retest this zone now, hold it, and bounce. Okay, now, and we come back with a red bar buy. Now, what makes this red bar buy better than just any old signal is a couple of things. First off, we can start drawing a trend line off of our lows right here. We've also encountered the hard edge, and we are actually retesting the top end of this trading range. I know that we've fudged it a little bit, but remember these lines that we draw on here, this box, these lines, they don't really exist, right? They only exist on our computer. The only thing that truly exists here is price. And just because we can look at our computer and we can say, oh yes, the top end of this trading range is 44.26 3/4, does not mean that the guys trading this are going to remember 44.26 3/4. They're more likely to remember 44.25. They're more likely to remember 44.20. And anything around this region then becomes an area of a retest. So when the signal prints, we're still against the ATR. This next bar brings us in sync with the ATR. So I would actually use that bar right there, this last bar, as my signal bar. Definitely you're going to want to cover at least below the hard edge. And I don't, oh, I have my wrong template here. I'm going to go change that in a moment, but all right, so we could set up our trade like this. If you're not sure, of course, dial down the risk amount. And again, the market comes up, we're giving it some initial risk, it comes down, starts to rally. I'm going to start bringing my stops up. I'm not going to leave my stops here. The buyers are pressing. I'm going to start bringing my stops up and perhaps even capture a little bit of profit. And then we tag our profit objective. But even if we didn't tag our profit objective there, okay, we would have got it there, but you can see I was anticipating maybe the market would come a little bit lower. I would still end up banking some profit. All right, so you have to actively manage your trade. Just because we try to set a liberal stop at the beginning does not mean that we're going to stay with that stop throughout. Okay, so I hope that helps a little bit, Marlene. If not, please ask questions. And there's a couple more questions here. Alex, welcome, Alex. Alex says, hi, Eric, I'm new from Spain. Oh, well, buenos dias. Well, it's morning for me. I guess it's buenos noches for you. Alex is asking, which parameters do you set in the Supertrend indicator? Supertrend's a great one. I used to use Supertrend a lot. Now I end up using the ATR more, but they're essentially the same thing. The Supertrend is the ATR balanced with a moving average, in case you didn't know. Not that it matters. The default is 2.618. I've always been a little partial just to make it 3, just to give me a little bit more initial staying power. And then what I do is I put it on the chart and I see how well it has been responding to the market. So let's say I bought here, Supertrend would keep me in until right here. Now, if that looks good to me, then I'll leave it at that. If that doesn't look good to me, then perhaps I'll make it a little tighter. Maybe I'll go with 2. So I would have got in here, Supertrend held me through here, and then took me out there. Okay, maybe I'll go with that. Or if you want to ride out the next swing, then maybe you need to dial it up a little bit more still. Oh, actually it has to be a little bit more than that too. All right, so Supertrend would have got me in here, or held me through all this, held me through this, and eventually, well, it would have held me the whole day. I would have had to close out by the end of the session. So that's really what I do with it. My go-to number is 3. It seems to work pretty well. Oh, Buenos Aires is only afternoon there. Craig is asking, on the Eagle, what does the hollow green and solid green bars really mean? Are they the same with the red? All right, let's take a look here. I get this question a lot about the Eagle. Okay, the hollow body bar is like your traditional bullish candle. It means the bar has opened low and closed high. Now that's just the bar itself. You see that we have red bars with hollow bodies, which means the bar opened low and closed high. The solid body bars are, as you probably have guessed by now, the opposite. They open high and close low. So you can see we have green solid body bars and we also have red solid body bars. The bars will print not only how it opens and closes, but the programming will also paint it whether it's bullish or bearish. So it's going to paint it either green or red, depending on, well, whether the market is more bullish or bearish, obviously. All right, so when you get a pullback like this, you get solid bar, solid bar, solid bar. This is very, very bearish at the moment. All of a sudden you hit the hard edge and you get hollow bar, hollow bar. And this, our red bar buy signal off of the hard edge, that's what makes this such a powerful signal. Is the market goes up and all of a sudden the sellers take the market and they just ram it down into the hard edge, and then the buyers turn the market. So it's looking like the sellers are taking total control. Sellers have a little bit of control here. The bars are still green, and all of a sudden the bars go red, suggesting the sellers have total control of the market. And all of a sudden the buyers come back and say, oh, no, you don't. In fact, the buyers changed the parameters so much that they produce a green buy signal, even though the bars are still red. So that's what makes the red bar buy so powerful. And its counterpart, I've got to go way, way back here, the green bar sell. These always come or tend to come within an established trend. You don't, sometimes you'll see them near the beginning, but not usually. Usually they're after an established trend. All of a sudden the buyers start to take the market. So it's green, red here, so the sellers still have control, and all of a sudden the buyers take control, and boom, boom, boom. Look at all these hollow bars. Look at how the buyers are just running the market. And all of a sudden the sellers say, oh, no, you don't. And we come back with a green bars and a red sell signal. That's our green bar sell in a downtrend. These signals will always occur at or near the hard edge. That's how you can identify them. And then look at the follow through. You know, very decent follow through. Certainly enough to find your profit objective. Once again, when you get a signal like this, you don't want to strangle your trade. It's so tempting. You know, well, the signal's here, I'll put the stops there, and away we go. Rather than that, though, give your trade a little bit of a chance. It should be obvious that, you know, if we break this swing high now, that's probably a good place to leave. So you set up your trade like this. The market bounces a little bit. And now it's recommitting to the move lower. So now you can grab your stops and you can start to bring them in. Right? So even if this trade goes sideways on you now, you're going to end up losing, I don't know, $50, $60, something like that. That's how you help protect your capital also. You may not always be right on the trade. These signals are good, but they're not 100%, unfortunately. So even if you're wrong on the trade, at least you've incurred less of a loss. But if you give that market just a little bit of room to sort itself out at the beginning, you'll probably be all right. Yeah, Marlene's asking an interesting question. If you've identified, say, a ranging market in the Eagle. Here, let's go back to crude oil because the NASDAQ is not really ranging at the moment. Okay, so we're looking at crude oil, and we've got a market that seems to be stuck right now. It seems to be stuck right here. She says, or she asks, would you still take a trade on the Hawk or the Falcon if the market is stuck within this range? Well, yes, I would, but knowing that the market is kind of range bound like this, it's going to hopefully make me a little bit more cautious. So here we are, we've got a first micro macro cross in crude oil, right? First micro macro cross signal. We know this is a high probability signal. In fact, looking at it like this, it looks as though this decline may just have been like a bull flag, right? And now we're getting ready to resume the trend. So I wouldn't have too much problem buying that. But knowing also that we're in this sideways, oops, wrong tool, this sideways congestion, this is the same zone that we're looking at on the Eagle, I need to anticipate that maybe we're not going to get the follow through that we normally have. So I'm going to enter here. I'm going to try to cover my stop or my trade deep to give it a little bit of a chance. And here we are. We're kind of floundering a little bit. Oops, doggone it. Keep hitting the wrong button. Floundering a little bit. Now the market recommits, and certainly it's time to start rolling your stop when it recommits like this and we finally hit our profit objective. So the signals are still quality signals, but because we know we're kind of in this congestion, this sideways range, don't expect the market, you get the signal, here's a macro pullback signal, you set it up, don't expect the market just to go boom, boom, boom straight to your signal. That's the mistake a lot of us make is we say, oh, first micro macro cross. I'll set it up. Okay, and how come the market's not going straight to my profit target? Well, because they don't always go straight to the profit target. Here's a macro pullback signal. Why is the market not going straight to my profit target? Okay, well, in this case, it is going straight to your profit target. But the market will move faster or be more committed when we get outside of this range, either higher or lower. I know, I'm trying not to be too confusing, but sometimes and this thing happens in a micro view also. So where we're looking at the Eagle and we're saying, okay, well, the Eagle is kind of in a sideways congestion. But when we take a look at the Hawk, we kind of get this little scenario happening in miniature. Right, and now here we are also. So you can look at each one independent. So we'll see now if this keeps going sideways. So are we in this type of phase, or is this merely a pause and now we're heading higher still? Craig is asking, what tick size would give me close to a daily view with the mean Renkos to give me an idea of the larger trend. Well, there's no one tick size that will do that for you. That's the downside of using a range style bar, Craig. What you can do is you can use your day ranger and you can look at your average daily ranges. So in crude oil, it looks like you're doing about 170 ticks at the moment. So if you set your mean Renko at 170 ticks, let's just see what that looks like. So let's say we're going to set it at 150 because 170 is a odd number. I've only got 50 days data on here. It's not going to give me very much. Well, it looks like we nailed it though. Each of these lines are daybreak lines, and it looks like we have about one line per bar. To get rid of those daybreak lines, go here to your session template under your data series, and I'm just going to make those transparent. So for the last 50 days, this is what your crude oil chart would look like. But the brick sizes change, right, relative to how the market is ranging. For the last 30 days or so, it looks like 150 might be a fairly accurate number for the crude oil market. That's not going to hold necessarily for the NASDAQ or the E-mini or whatever else you might be looking at. It's interesting to see, though, that the signals still print, though. Here's the first micro-macro cross. It might take a while to see a macro pullback. And yes, you know, doing this, sometimes you're going to end up sitting around for a while. But one of my favorite trading quotes from Jesse Livermore: "The money is made in the sitting and the waiting, not in the trading." We're not on the factory floor here, folks. We don't make more money by doing more trades. Okay, Marlene says, why do you say range bound instead of taking that red bar buy? I think she's referring once again here to the crude oil trade. You could definitely take that. But see, it's hitting the trend line, it's hitting the hard edge. It's a quality signal for sure. What I meant by range bound is that if you're looking at this market, we know there's resistance up here, right? This is where the buyers got stopped. This is where the sellers got stopped. Right? The sellers drove the market down all this way. Then we had some sideways action here as the buyers started to dig in. Then the buyers pushed the market up, and the seller said, oh, no, you don't. This is where we're going to stop you. And then the sellers tried to regain the trend, And the buyer said, oh, no, you don't. This is where we're going to hold you. So this is why I say the market is currently in a range. Because the sellers should have been able to force the market lower. But they weren't. The buyers stopped them. And because the buyers stopped them, well, the buyers stopped them here. They also stopped them here. We can draw a trend line. And with that trend line, we can say, oh yeah, here we go, red bar buy. It's coming off the trend line. We have room to profit before we encounter this resistance. Yes, there's nothing wrong with taking that trade. We're currently against the ATR. I'll let the ATR flip. Okay, the ATR flips over. I will use that. Oops, sorry. I will use this bar as my signal bar. I'll set up, oh, darn crude oil, I can't afford it. I'm going to set up the trade like so. Okay, the market hesitates. It gives me a little bit of a stagger step, time to bring the trade to break even. So now I've got my stops here. And here we are. Oh, actually my profit objective is too high. Sorry. We would have actually hit our profit target already, but you get the idea. No, there's nothing wrong at all with this red bar buy. Okay, so the market's trying to get now through the top end of this trading range. This is where the sellers knocked the market down last time, right? The buyers recovered it here, the sellers recovered it here. There's no reason whatsoever to suspect the sellers are not going to try to do it again. You know, they had a very good run lower. They took them from 53.20 all the way down to 50.80. That's a pretty decent move. It's more or less sideways through there. In fact, you could say they took them from 53.90. So 53.90, 53.80. Those areas are going to carry a whole lot of weight for the sellers. So does that mean there's no room to profit in here? No, of course there is. But am I going to be interested in taking, say, this buy signal here? We're getting a buy signal right there. Oops, sorry. We're getting a buy signal right here. Should I take it? Well, it's not one of our high probability signals. It's not hitting a trend line or anything like that. I'm going right into the area where I know there's active selling. If I produced a first micro macro cross here on the hawk, you know, at the same time, if I'm looking at my hawk and I'm producing a first micro macro cross, okay, there's probably enough room I can profit with my hawk. But I look at my falcon and I get a signal on my falcon. In fact, I think I did get the signal on my falcon. Hold on a second, I'll bring it over here. So here now is the falcon with crude oil. And we're looking about the same time. Okay, well, we can say this was our trend change signal. This is our high probability signal. Here's our trend line touch signal. We're coming right into this area of resistance, right up here, 52.50. Okay, it's the same range that we're looking at on all three charts. In fact, let's do this one because this is our high probability signal. Should I take this signal? Well, I might choose to dial down my risk amount, which I can't really do with crude because I can't afford it. So let's just do it this way. Well, actually, let's do it like this. Okay, so I'm in my risk percent mode. I'm going to risk 2% of my trading capital. This is a high probability signal. How should I set this up? Well, ideally, I want to run my stop below there. But Trade Manager is telling me, no, Eric, sorry, you can't afford that. So what do I do? Well, if I'm really determined to take the trade, I could use maybe my primary resistance line to take the trade. And I've got a chance at a profit before we get to the resistance up here. So this trade at this point doesn't look all that bad. I've got a reasonable stop. I've got a reasonable chance to hit my profit target before we encounter all this resistance. So I go ahead and I take it. The market goes up and it comes down and now it's going up again. So what I'm doing now is I'm going to take my stop from here and I'm going to run it here. Why am I going to do that? Well, I'm a buyer. And the buyers have shown, the sellers made a little effort here. The buyers have shown a renewed interest in buying. This may be their last chance to find my profit objective. I'm not going to hold my stop way down here and leave $500 on the table. I'm going to run my stop in here. So maybe I've got, I don't know, $150 at risk or so. Okay, and then they're pressing again. Okay, so now I roll my stop again. This is really now their last chance to get the job done. And now I'm probably going to take the trade to break even. And there we hit the profit target. But what happens after we encounter the highs and the profit target? Oh, the market starts to reverse against us. So you need to balance these things. I know Josh just wrote, crude oil just broke out. Yes, it did, but the question is, will it stay broken out? Trading friend of mine always used to say, never trust a breakout. Well, how can you trade? You ask? Well, we let it break out. We let it retest. We let them show their commitment, and then we buy. There will be a buy signal here, I guarantee it. Likewise to the downside. We let it break out. We let them retest. We let them show their commitment, and then we sell. If you don't believe me, go through your charts and see it for yourself. Well, that's not a very good one because of that gap. Let's say, all right, sure. Let's say we have identified a trading range on this high and this low. Okay, the market breaks out. Oh, look, it comes back with a retest. Oh, look, it comes back with a sell signal. Breaks out, retests, and then we're ready to sell. You see, we're all so scared to death that the market is just going to bolt when it finally breaks out that we take less than desirable trades. Don't worry if you miss a move. Don't worry if it's the biggest move of the year and you miss it. My claim to fame is that I bought the high in cotton one year. Some of you will have heard this story. I remember it clearly because it was on April 1st, April Fool's Day. I bought the high in cotton. As soon as I bought it, no word of a lie, the market turned on its heel and went and a much bigger than this. But it will happen time and again. Just go through your charts. Excuse me. You know, you see a market with a little bit of range. This is why we look for things like tests of the extreme, right? This is an early tip-off that this market is getting ready to head lower. All right, let's say you've identified a range in the market as like such. Oh, look, it broke out. Oh, look, we're getting a retest. Oh, look, we're getting a sell signal. Okay, this sell signal had a little less follow through to it than we would have liked, but the principle remains the same. And sometimes these retests will be a little bit deeper. See, we're making higher lows. The market's starting to become a little bit more bullish. And right now, everybody is thinking, oh dear, the market's going to take off without me. I'd better buy in. Well, what if we didn't? What happens? It goes up, it breaks out, it comes down. Oh, look, we get a retest. Now, this retest is different, right? It didn't bounce here and go up. It went a little bit deeper. Why did it go a little bit deeper? Well, probably because this whole area through here is not as well defined as we would have liked. So in fact, the breakout looks something more like this. The point is we don't want it to retrace too deeply. You know, you can say that, oh, well, the market broke out here, it retested, and it comes back and I'm going to take this buy signal. Well, okay, in this case, it would have worked out. You would have been lucky. But when a market retraces this deeply back into a trading zone, let's say you've identified a trading zone off of this high, it breaks out. If it retraces this deep into the trading zone, that's not a retest of this resistance here at 5170. The fact that the market rallied from here is a little bit more luck than skill. This retest here at 5170 should have recovered, you know, something around here and then put in a rally. But like I said, just go through your charts. You'll see it time and again. So here we are. Okay, crude oil, we got the breakout. Notice how what happened after the breakout. Sellers jumped all over them. All right, big deal. Now we'll wait for the buyers. How serious are the buyers about buying this market? Well, I'll tell you one thing, if it gets down here to around 52 or 52.10, somewhere around the hard edge of our eagle band, somewhere near the trend line, I would think the buyers would be very interested in buying. This is like a grocery store, folks. You know, you're walking through the aisle and you see your favorite coffee on sale. It's normally whatever it is, say $10 and it's on sale for $5. You think maybe you'll pick up an extra bag? Sure you would. Michelle says her support and resistance lines on her August crude oil are different than mine. Let's see. So my data is set at 30 days and 24.5. Shoot me a screenshot, Michelle. Are they significantly different? She says yes. All right, well, send me a screenshot. We'll see if we can't get to the bottom of it. Attaboy, Jim. Jim's the Jim and Mark. They're the only ones trading this morning while I'm doing my little presentation here. Jim says the advanced decline is, well, pretty much even up, slightly bullish, only about 200 to the positive. 1,500 buyers, 1,300 sellers. So the market's still looking fairly bullish for the most part. Marlene asks, what are my targets on oil? The profit targets remain the same, but because crude oil is so volatile, I tend to double the objective. So our normal profit targets are $50 on the Hawk, $100 on the Falcon and Raptor, $200 on the Eagle. And those are very easy targets for crude oil to reach. Because of that, I tend to double the objective. So instead of having a $50 target or what would be 5 ticks on crude oil, because it's $10 a tick, I instead have a $100 target for my Hawk, $200 target for my Falcon and Raptor, and a $400 target for my Eagle. But crude oil is, it's a difficult market. Quite honestly, the only reason I follow crude oil a lot of times is because so many people love to trade crude oil. They love to trade crude oil and the E-mini. There's nothing wrong with those markets, but they're not high, really high on my trading agenda. I prefer value. I prefer the NASDAQ, which you can see gives very good moves. And at $5 a tick, I have the ability to structure a trade with, a reasonable stop. I can run my stop all the way down here if I wanted to on the NASDAQ. I certainly could not do that on crude oil. On crude oil, I'm taking trades that, give me sweaty palms because I got to run a trade that looks something like this. And even in that case, it'll be the $400 on the table. Yeah, like Jim says, he says that's one of the best things that I learned was learning to spot where the buyers and sellers are. And the chart will tell you a story if you kind of take the time to read it. Well, again, the NQ not the best example because it's been all buyers, no sellers. But let's take a look maybe at soybeans. Okay, so here's soybeans. They put in this is soybeans now on our eagle. So the soybean buyers put in a big rally. The sellers stopped them here. And now the sellers are trying to force the market down. Big move lower on the part of the sellers. This market is very evenly balanced. Oh, we had a green bar sell right here. So the buyers starting to try to rally, and that would be off of these lows that we saw back here. Right? The buyers are starting to get a little bit anxious. They're saying, okay, that's low enough. And the sellers are saying, nope, I think we'll run it a little bit lower. And as we get back down here to 10.15, 10.12, we're going to see the buyers step up yet again. But that doesn't mean there isn't room to profit. So here was our signal. This bar here changed the ATR. I would have used that as my signal bar. Probably covered the trade something like this. You're going to notice soybeans, I tend to go with a larger profit objective also. But let's just dial in the high probability profit target here. And we'll go there, we'll go there. Soybeans shouldn't have too much trouble finding that. And what happens if we head down? And what happens if the buyers step in here and they start to press and they start moving the market higher? Well, if I'm running a break-even trigger, my trade would currently be at break-even, but let's take a look at this for a moment. The buyers start to buy the market back up. They say, oh no, we're not going to let it go below whatever, 10.24, 10.25. That's where the buyers find the pricing attractive. Well, given that the sellers have moved the market substantially lower, do you think they're just going to walk away from here? You know, the buyers bring the market up like this. Do you think the sellers are just going to disappear, run away, shaking in their boots? No, not likely. Sellers are likely to give it at least one more press. And when you see that happen, then you can bring your stops in. Now, whether or not they'll get low enough to actually resume the trend and find your profit objective, well, that's the $64,000 question, isn't it? Or whether the buyers will once again gang up on them and turn the market and start heading higher. But if they do, you know, you can manage your trade to the point where, all right, you initially had $300 at risk, you get stopped out and you may end up taking, I don't know, a $50, $60, $70 hit, which isn't the end of the world. Certainly better than taking a $300 hit. This is what people, they're always asking me, well, Eric, you can't do a trade like this because you're only getting $200 profit and you've got 300 and change in risk. Or with our hawk, where we have our $50 profit targets, and sometimes we're risking, you know, $300, $400 on a trade. If the trade goes sideways, yes, you've just eliminated as many as 8 or maybe even 10 good winning trades. Well, this is what you need to do. You need to watch your positions and, you know, recognize, okay, we're in a downtrend. If by chance the buyers try to rally here, the sellers are going to step up once again. If they don't, okay, I have my fail safe. I take a $300 hit. But the sellers should attempt to bring the market lower at least one more time. That will give me an opportunity to reduce my risk. It does happen. It happens all the time. Soybeans kind of taking their time here. But it looks like soybeans poised to head a little bit lower. We'll put that back on the shelf. All right, let's see if I missed anybody's question. Alex is asking, where can I see the recordings? They're on the Indicator Warehouse YouTube channel, but it will take a few days to post them. So make a note of today's date, July 14, and by the time the video gets processed and uploaded, it's usually a couple of days. The webmaster is moving, so all this sort of stuff is a little bit behind schedule. I apologize. I'll be saying the same stuff again tomorrow and the day after and the day after that. So if you forget, just come back into the room and say, hey, Eric, what was that you were talking about the other day? The markets always do the same things. And once you learn to recognize that, well, I don't want to say trading's not difficult. Trading is difficult. For crying out loud, we're trying to predict the future. But when you get a better idea of what the market is doing, what phase of the market you're in, like right now with our little accumulation type thing, we are definitely in this phase of the market in the NASDAQ, right? It showed some signs of moving sideways, but nope, we're not there yet. We are definitely still in this phase of the market. And there's no telling how long that phase will continue, but it will continue until it starts going sideways. And this will not be a surprise, folks. These things rarely sneak up on you, although sometimes, they'll have this type of look to them, which makes it a little bit difficult to say, oh yeah, oops. Which makes it a little bit more difficult to say, oh yeah, we're in that little bit of a sideways thing going on. Oh, and then the market breaks. Oh, we get a retest, and then it starts heading lower. And it will keep heading lower until it hits that phase where we start flattening out. And that too will not be a surprise. But sometimes it's going to have this odd look to it. Sometimes we get lucky and it looks just like it does in the textbooks, but not always. Jim says, what's that expression? Never short a dull market? Well, he shorted the YM at 20. You know what? I'm all for selling dull markets. I figure gravity will do the rest. I'm not familiar with that one, but I do know the inverse of that is you always need to feed a bull market. So a bull market is always looking for fresh news, looking for a reason to go higher. A market doesn't usually need much of a reason to head lower. But they're definitely slowing. That seems to be the modus operandi of late. Yeah, Marlene says when you're in the trade before it hits the plateau, it's hard to tell if it's going sideways or retesting. Yes, it is, which is why you need to give yourself a reasonable stop. So let's say this is not a signal, folks. Please do not think this is a signal. But let's say, for instance, this was a macro pullback. Let's say it didn't go into yellow bars. So the market definitely still advancing. There's reasons not to trust this macro pullback. Namely, looking back here, we've had, well, at least 2 macro pullbacks already. And as we know, we tend to only get a couple macro pullbacks within a trend. But let's say we did take this signal. It's not a signal, but let's say we did take this signal. How do we know the market's going to head higher and not start going sideways? Well, we don't really. So we need to give ourselves a reasonable stop. So the market goes up a little bit, and let's say it starts coming against us now. And now we're starting to get a little bit concerned, especially since it takes out this low. Every reason to be concerned when that happens, because the buyers are losing their grip on the market. But once again, does that mean the buyers are totally going to walk away from this market? No, not at all. They've been rallying the market for 2 days. They're not going to walk away from this. Is there a chance the market will fall and hit your stop loss? Yes, definitely. There's always that chance. But there's also going to be a point where the buyers will recover the market. Now, whether they'll recover to the point where you can get the trade to break even or not, we don't know. But they will recover it to a point where you can at least reduce your risk somewhat. And let's say they turn it here and you get stopped. Okay, well, you get stopped and it looks like you get stopped for about half of what you originally had. So you're going to get hit for about $80. Was it a valid signal? Well, we're pretending now it's a first or a macro pullback signal. Yes, it would have been a valid signal. Did you do anything wrong? No, you managed the trade the best that you could. It was just one of those things that the trade did not have any follow through to it, or not enough follow through to it. But you'll notice if we concentrate on the proper signals, so here's the macro pullback, and let's say, we try to give it a reasonable stop, we hit our profit target. So the stop is merely your safety net. You don't want to put that stop in so tight that the trade doesn't have a chance, but at the same time, you don't want to leave it so loose that you're not able to take the trade with a reasonable amount of size. Marlene's asking, what's my favorite bird? Well, the way I'm wired, it's the hawk, because I like being a scalper. I like being all in, all out. I don't like having to sweat a trade very much, but that's me. Other people, see, I can look at a chart. Let's go to the eagle because it's a little bit more condensed. I can look at a chart and I'm okay that I missed this. I'm not happy about it, but I know it happens, right? It's not going to be the last move I miss. I know people who would be berating themselves so badly for missing this move. So for people like that, the hawk is not your tool, because if I took my first micro macro cross here, the signal right here, my first micro macro cross, I go in, I get my 50 bucks, I get out, I'm okay with that. And then the market goes like this, and let's pretend it didn't give me another signal to get in. We had several, but let's pretend it didn't. I know people who would be terribly upset with themselves. And yes, it's annoying. I only made 50 bucks. I could have done a whole lot better. But like I said, you got to remember what we're doing. We're predicting the future here. We're trying to gauge what we're seeing, what's happened in the past, what all the computer programming is trying to decipher about what's happened in the past, and we're trying to base a decision on whether we want to risk money on this scenario. And then when we do choose to risk money on the scenario, how are we going to set up the trade to give ourselves the greatest probability of making a profit, which means, setting a reasonable stop, trying to judge, do I have enough room to profit in here before I start to run into trouble? What is the market doing overall? Well, overall, it's in a great big rally, right? I think I have a channel tool here somewhere. Let's make this something we can see. Here we go. Okay, so we're still in this channel. Am I going to find it an attractive buy near the top end of this channel? No, probably not. If I get a first micro macro cross signal or something on my hawk, well, yeah, okay, I'll take it. I'll have a little bit more opportunity to profit on that than I will on my eagle. If my eagle, however, retraces back here, gets to the hard edge, maybe even to the channel, somewhere around 4,500, that would be a more attractive buy. If it comes back, gives me another red bar buy, that would be okay. Still seems to be honoring these lines reasonably well, though. It's not getting shallow yet. It's not doing one of these where it comes down, bounces, and now it's starting to get shallow, right? We're starting to come up short. Oh, we just violated the trend line to the downside. Oh, we're getting a retest, and then the market starts going the other way, right? That's how it's going to unfold when it happens. See, here's a possible late filter entry signal on our Falcon. Well, we had a late filter here. Okay, so we know the late filter entry signal is a fairly reliable signal. Let's see if I dial down the risk here. The market's just been kind of blah. Can I cover it down here? Nope, I can't. Can I cover it halfways maybe? Yes, I can. So here we have our late filter entry signal. It's our second signal within the trend, which is not as desirable as the first. Marlene says her favorite bird is, she seems to have the turkey trader. I wanted Adam to call one the chicken trader. Alex is asking about this squiggly red-blue line. This is simply just an ATR line, and I've adopted this from Mike Filigera. He's the fellow who trades the DTS system for the stock markets. Go here to your indicator panel, and from your indicator panel, scroll down here to all these indicators that start IW, and you're going to find one that says IW TM ATR trail. If you double click on that, it's going to appear down here in your assortment, and then simply apply and OK, and it's going to be on your chart. And all it is an ATR. We're just using it as an added filter. Excuse me. It's kept me on the right side more often than not, which is why we've adopted it. Marlene is asking, what about trading off hours, i.e. very early in the morning, like 6:30 a.m. Toronto time? So 6:30 a.m. Toronto time, the European session will be the most active. You might want to take a look at some of the European markets like the British pound or the euro. I'm going to pull up a euro here in a second. See what's going on with the euro. There's also markets like the CAC 40, which is the French stock exchange. The DAX is huge, but insanely quick. So here is the euro, and what I've done with the euro is we're going with our alternate settings because it's at 1250 a tick. Now you'll have to see whether the signals unfold too quickly. If they do, you can go back to the standard settings, but normally for markets that are trading at 1250 a tick, we go with our alternate settings, a 4-tick hawk, 4-tick falcon, 6-tick eagle. So 446. This last night was nothing, so let's go here to yesterday's session. So you're looking around 3:30 my time. So when you opened up your charts, it was a jumbled mess, but it did come out with about an hour later. You got a first micro macro cross signal lower. This one right here. That seemed to have some follow through. went into a macro pullback. Now this macro pullback signal that we see right here, this is not the type of thing that you necessarily want to take right on the hash mark. If you see the market making what appears to be a bear flag type formation, we can fully expect it to head lower. But at the same time, let's not get in any earlier than we have to. If we have the ability to draw a trend line, let's draw the trend line and use that. Why do trend lines work? Well, they show you where the buyers and sellers are prepared to buy and sell. We're not the only ones who see these trend lines. But the nice thing about using this is, it avoids this type of scenario. If you're buying it exactly on the hash mark, you would have sold here, and now all of a sudden you're sweating this trade, right? It did go lower, but again, this is one of these test-retest type scenarios, right? We get the breakout, it retests, it comes lower. So had you sold the macro pullback here, it all depends how deep you ran your stop, whether or not you were able to ride out this swing. It's always a shame when you take a trade like that, the market reverses on you, stops you out, and you end up being right because it eventually ends up going lower and finds your profit target. In the meantime, you got stopped out, which is why I say if you have the opportunity to draw a trend line in here, by all means, draw the trend line. And even if you don't draw it like that, if you take, although the peaks are pretty close. I was going to say you could draw your peaks and transfer them over, but it's pretty much the same type of channel. That type of thing helps keep you out of potentially bad signal also. So anything more out of the euro? Yeah, a little bit. The North American Open and the euro a little bit quieter than it normally is. So there's euro on the hawk. I'll pull up the British pound here and we'll see what's going on with the pound. So crude oil after that initial, oops, where'd it go? There we go. Crude oil after that initial breakout. It's in retest mode now. So we've effectively got this type of range going on. Okay, so here's the British pound now. We'll start with the hawk. Oh, I should have looked at the falcon and eagle for the euro also, but I'll get the idea. Okay, so again, the British pound a little bit quiet. And again, I'm going with the alternate settings here. I'm just looking at the timestamps. Yeah, something happened here. There was no way you would have been able to take advantage of this move here. This all printed in the matter of seconds. But about a minute later, you did get a first micro-macro cross lower. Which, well, it looks like it struggled for a bit. Let's go back a day. And again, all I'm doing is looking at the timestamp here at the bottom. I don't want the signals printing too quickly, and I don't want signals that are not producing anything with follow-through. I need follow-through. All right, so you wake up, you get to your computer, it looks like the market's in a little bit of a rally. It comes down, gives you a first micro-macro cross. That had some follow-through to it. You get into a macro pullback, but it's spoiled by yellow bars. I suppose you could call that a 4-arrow consolidation. 1, 2, 3, 4. I will sometimes take a 4-arrow consolidation off yellow bars. And it looks like that would have found your profit target. Let's go back one more day, and then we'll take a look at the Falcon and the Eagle real quick. Okay, so here's about 3:30 Ontario, or sorry, 6:30 Ontario time. Yeah, got a little bit of a rally. First micro macro cross, a macro pullback, another macro pullback. You'd have to sweat these a little bit, but they did eventually head lower. All right, let's take a look at the Falcon. You're always better off trading a market with its native time zone, if you can. Markets like gold and crude tend to trade 24 hours, but they're not always really active. Okay, so you see how we're almost here to our break-even trigger. If we weren't just about to hit the break-even trigger, I would roll my stop right here. Okay, so let's go back now to the British pound on our... Okay, this morning was nothing because of the Greeks. Let's go back a day. No, today's the 14th. Got to go back a day. Oh, come on. Here we go. Oh, Marlene was asking my favorite bird. I said it was the hawk. The consensus is the falcon. It seems like the falcon, as far as favorite tools go, the falcon is it, in case you were wondering. So nice little trend change signal, along with a trend line touch, about 7 o'clock, 7:30 Ontario time. Good follow through on that. That's on the British pound. Let's go back another day. Okay, well, if you got up a little bit early, no, this was an early trend change signal. I'm not going to lie to you. That would have been a tough one to take. So we have a market in a monster rally, and then it comes back here with a trend change signal and also a late filter entry signal to the downside. Now this looks oh so tempting, but it's important to take a look at what preceded all this. Right? Was there a really good test of the extreme here? The market has made a monster rally. Do you think this is all that's going to happen before the sellers force the market lower? Well, probably not. So you may want to look for a test or retest. Maybe you want to delay your entry. You definitely want to dial down your risk amount. I would not go in for the full Monty on this one because of this strong uptrend preceding it. Did they bring me in anyways? Oh no. See, so what I did is I delayed my entry below the low. I caught a little bit of a lucky break. I wonder if there was enough here that I could have shot a trend line across the bottom, if a trend line would have kept me out of that. But at any rate, I won't lie to you, that was not a signal that I would have been able to take, not on the Falcon. We did get a trend line touch here, a little bit of a hiccup to the upside. So the British pound hopping around a little bit on the Falcon for a couple of days. Let's take a look now at the Eagle. And we'll go back. So here we are, 6:30 Ontario time. Yeah, not much on the Eagle, not on the British pound anyways. I'll go back one more day. The Europeans are usually very civilized about their trading in that they tend to respect support and resistance. They tend to respect the way the market should work. There's probably fewer amateurs trading the European markets than there are the North American markets. We did get a nice with trend signal here around 3:30. It's funny that the Eagle was the only tool to pick that up. I think we missed it both on the Hawk and the Falcon, but the Eagle saw it, probably because it resulted in a nice trend. So a little bit of flip-flopping, a trend change signal. This is a rule of three type signal. Oh, come on, head lower already. There we go. So, yeah, a couple opportunities in the pound. The British pound is nice too because it has a smaller tick value, like the NASDAQ and the mini Dow. It's 625 a tick. So it's a little bit less expensive. Not a lot, just a little. All right, you guys, I think we're going to button up the room. I've got a meeting with Adam in a few minutes, so I'm just going to get ready for that. Tomorrow is Wednesday. Remember, we're meeting at the open house room tomorrow, at the public trading room, not at this one. All right? So I'll see you guys tomorrow morning. We'll talk to you then. Bye for now.